Well, I'm Jayendra Rana, and the topic for the discussion today is surety bond insurance in India. Surety bond insurance in India. India, with its growing economy and expanding population, is poised to become the world's third largest construction and infrastructure market. The surge in infrastructure development is expected to necessitate a staggering US $1.5 trillion in investments over the next decades. So surety insurance is a financial instrument that ensures the work starts on time for these projects and protects all stakeholders involved. In recognition of this, the IRDAI took the initiative to open the country's surety bond insurance market for the first time. This move is expected to significantly address the enormous amount of infrastructure cover needed in the coming years. The construction industry alone offered bank guarantees of rupees 1.70 lakh crores in 2019. And this figure is projected to grow to rupees 3 lakh crores by 2030. So surety insurance has a surge or a huge role to play in India's infrastructural development. So surety bond insurance acts as a risk transfer mechanism and is an alternative arrangement to bank guarantee. We want to understand what exactly is surety bonds. The answer is surety bond insurance acts as a risk transfer mechanism and is an alternative arrangement to bank guarantee, protecting the project owner from potential losses if the contractor fails to fulfill their contractual obligations. So surety insurance acts as a financial safety net in three-party transactions it involves. First, the principal, often a project owner. Second, a contractor responsible for completing the project. And third, a surety provider, that is typically an insurance company or banks. So in simpler terms, the surety company steps in and assumes financial responsibility if the contractor defaults on the project. Consider an example. Imagine a city planning to build a new bridge over a river to improve traffic flow and connectivity. The city council hires a construction company, XYZ Builders, to undertake this major infrastructure project. Now, to ensure the project is completed as per the agreed terms and quality standards, the city requires XYZ Builders to obtain a surety bond before commencing works. Now, this bond guarantee that if the contractor fails to fulfill their obligations, such as completing the project on time or up to the agreed standards, the surety company will step in to compensate you for any financial losses incurred as a result. In this way, the surety bond provides you with assurance and financial protection throughout the project development process. So the surety company assesses the contractor's qualifications and sets a bond amount. If the contractor fails to uphold the agreement, for instance by doing poor quality work or not finishing the job, so you, the obligee, can file a claim with the surety company. So they will then investigate and if valid, compensate you for the financial loss up to the bond amount. This could involve finding another contractor to complete the project or reimbursing you for repairs. So surety bond insurance serves a dual purpose, ensuring legal compliance and guaranteeing contract fulfillment upon paying a valid claim. The insurance company has the right to seek reimbursement, that is subrogation, from the contractor for the covered losses. Moreover, surety bonds are recognized as one of the most effective ways for contractors to secure contract obligations. This translates to several advantages for contractors, like alternative to bank guarantee. So surety bond serves as a viable alternative to bank guarantee, offering similar financial security for project owners while ensuring timely execution, reduced procedural time, cost effectiveness, and minimal formalities. Then access to working capital. Contractors can retain their own funds by utilizing surety bonds. This allows them to bid on more tenders and contracts, enhancing their business prospects, and then preserved credit lines. So surety bonds don't tie up a contractor's bank credit limits, freeing up those lines for essential purposes such as working capital or financing expansion plans. So, having grasped the importance of surety bond insurance, it is time to delve into the various types of surety bonds. Knowing the different options available will enable you to choose the one that aligns with your particular requirements. So, the bid bonds means purpose, assure the project owner that the bidder will honor their bid and will execute the contract at the price if awaited at bid price. Example, a construction company bids on a government project to build a new school. So the bid bond guarantees that if the company wins the bid, they will enter into the contract and provide the required performance and payment bonds. If the company fails to do so, the project owner can claim against the bid bond to cover the cost difference of awarding the contract to the next lowest bidder. So this is called bid bonds. The next one is performance bonds. The purpose of such performance bonds is guarantee that the contractor will perform the work according to the terms of the contract. Example, say a contractor is hired to build a bridge. Now the performance bond ensures that the contractor completes the project as specified in the contract. If the contract defaults or performs poorly, the project owner can claim against the bond to hire another contractor to complete the work or to cover the cost of correcting any deficiencies. And the third one is payment bonds. Purpose of such bonds is to ensure that the contractor will pay subcontractors, laborers, and suppliers as per the agreement. Now, a general contractor is overseeing a large commercial building project. So, the payment bond guarantees that all subcontractors and suppliers will be paid for their work and materials. If the general contractor fails to make these payments, the subcontractors and suppliers can make a claim against the bond to receive their due payments. Fourth one is maintenance bond. Purpose of this bond is to provide coverage for a specified period after project completion to address any defects or issues that arise. For example, after completing a highway project, the contractor provides a maintenance bond. So the maintenance bond guarantees that any defects in workmanship or materials discovered within the specified maintenance period, for example 1 year after completion, will be repaired at no additional cost to the project owner. So if the contractor fails to address these issues, the project owner can claim against the bond to cover the cost of necessary repairs. Now that we are well versed in the various types of surety bond insurance, we understand how the premium calculation is done. The premium for a surety bond is typically a small percentage of the total bond amount. It is influenced by several factors including contractor's financial health, that is a strong financial statement and credit history can lower the maximum. Then project complexity and risk. High risk projects or those with complex requirements may attract higher premiums. Bond amount. Larger bond amounts usually have lower rates due to the scale, but higher absolute premiums with tenors typically ranging from 12 to 36 months in a context of surety bonds. And the last one is experience and track record. The contractors with a proven history of successful projects completions may receive lower premiums. Now the tenure of surety band varies based on the project duration and the specific contractual requirements. So typically the bond is effective for the duration of the project plus an additional period to cover potential claims, which might be a year or more post completion. So this ensures that any latent defects or performance issue arising shortly after project completion are also covered. The maximum bond tenure is 60 months, including contract maintenance period or extensions, or based on the contract bond, whichever is lower. So having reviewed the specifics of surety bond insurance, remember that it is an unconditional bond that ensures the contractor cannot dispute or reject any terms and conditions outlined in the agreement. This type of bond provides security and assurance to project owners, ensuring that the contractor adheres to the agreed upon standards and deadlines. The surety insurance is still a relatively new concept in India, and its full potential is yet to be discovered. As the market matures and the regulations evolve, we can expect to see a broader range of surety products catering to diverse project needs. Increased awareness and education among the stakeholders will further drive adoption. Surety insurance holds immense promise for fostering a more secure and efficient infrastructure development in India. It can bring a brighter infrastructure future by mitigating risk and ensuring financial accountability. So this question, how big is the opportunity, is important because surety bonds are generally required for 5 to 50% of the project's value. So let's go with 25% considering the $122 billion investment planned by Government of India in infrastructure in 23-24. So this means that the surety bond required, if surety bonds were to cover the entire market needs to the tune of $30 billion, assuming a 25% GWP. It could range anywhere between 0.5% to 10% of the total bond amount. So it's a $763 revenue opportunity for an insurer. So the Insurance Regulatory and Development Authority of India introduced a framework for surety insurance set to be implemented on April 1st, 2022. The RDI Surety Insurance Contract Guidelines 2022 came into effect, enabling Indian general insurers to offer surety insurance products. This date marked the official commencement of surety bond operations in India's insurance market. In December 22, India's first surety bond insurance product was launched by the Road Transport and Highways Minister. This significant event introduced surety bonds to the Indian market, aimed at reducing infrastructure developers' reliance on bank guarantee. Bajaj Allianz General Insurance was the first company to launch this project, marking a crucial milestone in the adoption of surety bonds in India, followed by New India Assurance. In May 2023, SBI General became the third insurer to launch a surety bond product. In June 2023, 6 months after the launch of the first surety bond product, there was still no significant adoption of the instrument. But in September 2023, despite announcement from leading insurers like New India Insurance, ICICI Lombard, SBI General Insurance, and Bajaj General, the market for surety bond struggled due to the absence of essential supporting elements. Then in May 2024, insurance companies had issued approximately 700 surety bonds, valued at around rupees 3,000 crore, that is $360 million. At a workshop organized by the National Highway Authority of India, it was revealed that 164 insurance surety bonds had been received, including 20 for performance security and 144 for bid securities. In June 2024, Tata AIG General Insurance issued India's largest performance surety bond, valued at rupees 100 crore, that is $12 million. So more than 2 years since the framework was implemented and 1.5 since the first product was officially launched, only a minimal fraction of the market has been covered. It is obvious that the market adoption has been slow, or at least not to the expectations. But it is really a problem of market adoption or of the underwriter's ability to service the market. Because the surety bond currently presents several challenges for insurance companies that lack expertise in risk assessment for this type of business. So as of today, there is no clear guidelines on pricing, recourse against defaulting contractors, or insurance options. These issues are critical and may hinder the development of surety-related expertise and capacity, ultimately determining insurers from offering these bonds. Thank you. Thank you very much.